Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's AdMail, Real Estate IRA. 3 questions that surround the topic of using an IRA to buy real estate, which ultimately is the most popular investment for self-directed IRAs and 401ks. So we'll probably be doing a lot of questions on this topic. This, let's say, is part 1 of maybe a, 3, 4, 5 part series of questions on real estate IRAs, since I get the majority of questions on this topic. Over the last couple of months, I kind of built up to this point, giving you more basics on IRAs, 401ks, contributions, transfers, rollovers, distributions. Now I want to get into some real estate topics, and also we'll sprinkle in some prohibited transaction discussions, and also some discussions on unrelated business income tax, which gets looked at with, at least definitely gets uncovered and potentially examined with real estate investments. So first question is from Isaac P. Isaac wants to know, is there anything in the tax law that prohibits me from buying real estate in my IRA outside of the United States? So actually, no. The tax code essentially only says there's 3 things you cannot do with an IRA, found in section 408 and 4975. 408 says you can't buy life insurance or collectibles like art. And 4975 talks about transactions that are not permitted, essentially prohibited transaction categories, which in some say, when it comes to using an IRA or 401k, you cannot do anything with your IRA or 401k that in any way directly or indirectly personally benefits you, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. It doesn't say real estate, doesn't say US, foreign, doesn't say hedge funds, doesn't say private equity, doesn't say private stock, doesn't say publicly traded stock, doesn't say anything like that. It just gives you those broad rules. So in the case of foreign real estate or US real estate, 4975 doesn't really even mention real estate, right? It just says the things you can't do, which essentially is you can't directly or indirectly personally benefit, receive a salary, personally guarantee a loan involving yourself, a lineal descendant, or entities controlled, and the retirement account. So the word real estate isn't allowed or prohibited. It basically, as long as the investment does not fit in to a self-dealing or conflict of interest type transaction outlined in 4975, you can do it. So to answer your question, Isaac, yeah, you can technically do investing in the US or outside the United States, as long as it doesn't violate 4975, meaning there's no disqualified person that's directly or indirectly personally benefiting from the investment. It's not a self-dealing or conflict of interest. You can do it. So yes, you can invest outside the United States, so long, again, as you don't violate 4975 and the investment doesn't directly or indirectly personally benefit you or a lineal descendant or any entity 50% or more controlled by such persons. Second question is from Juan R. Juan wants to know, I want to buy real estate in my IRA. The price of the house is $375,000. I have $280 in my IRA. Can I use personal funds to get the deal done? So great question, Juan. I get this question a lot. I would say, and I've said this a lot, but one of the more popular real estate questions, can you commingle personal retirement funds? So again, it comes down to the analysis of 4975. Are you commingling? Are you using your IRA in any way to personally benefit you personally? So can an argument be made that you want to buy this house personally, but you need the 280 to do it? Depends, right? A lot of it's facts and circumstances. Obviously, in the perfect scenario, you're only using retirement money, right? So then there's no personal benefit. There's no conflict of interest. There's no self-dealing analysis because you're not using personal funds. So clearly all the benefits being derived by your IRA, and there's not really much to discuss. In this scenario, obviously, anytime there's a mixture of personal retirement money, you're definitely opening that window, depending on how wide, to a potential intrusion by the IRS to say, hey, this looks like it's self-dealing. Could the IRS say, hey, Juan, you really want to buy this personally? You only have whatever, 70 grand, 80 grand personally, and you want to get this asset. So you're using your IRA to personally benefit you personally. Maybe a stretch if you're not using it personally, one thing. Number two, you have a lot more money in your retirement, in your personal account. You could do this personally, right? You have 100K, you can get a mortgage, but you want to use your IRA because it's a really good investment for your IRA. That's another good fact. Another way people structure this is they basically say, okay, under the Swanson case, which is a 1997 tax court case, 96 tax court case, the Swanson case, the court basically says this: an entity, a newly established entity, only becomes disqualified once it's funded. So if you set up a LLC in Florida or Texas, New York, and put no money in it, technically it's not disqualified, right? No one owns it. It's a shell. Only when it's funded with cash, whether it's IRA or personal money, does the prohibited transaction rules become into effect, because only then can the entity be disqualified because it's funded. So what, I've written about over, the last 15 years, and what a lot of my colleagues that I respect have said is, okay, if you fund this entity simultaneously using 280 personal, say, I don't know, 75, 80, 280 in your IRA, 70, 75 personal, co-fund the entity at the same time, right? Wire from two different bank accounts into your new LLC bank account. So now the LLC is 350, and you basically then lock the LLC up. You don't add any more money. You obviously don't provide services. You don't take a salary from it. And it's essentially just an investment entity. All the profits and losses go pro rata, whatever the percentages are based off the amount invested. And based off Swanson, you could take the argument that, hey, we set up a new entity. It wasn't disqualified. We then funded it. At that point, yes, the entity becomes disqualified. But if we're not adding any more money to it, we're not taking any money out from a salary, everything is going pro rata, meaning 70, 30, whatever the percentages are to the IRA and personal. How could there be any prohibited transaction? Because the disqualified entity, there's no further triggering of the prohibited transaction rule. Yes, the entity becomes disqualified once it's funded, and nothing's occurring after the funding, right? No one's taking any money out. There's nothing happening to put the prohibited transaction rules at work, right? So that's what a lot of folks have done over the years. I've written about it. Again, obviously in a perfect scenario, you are essentially saying, okay, I'm just going to use personal money. I'm just going to use IRA money. That's obviously the simpler approach. Okay. The more aggressive, well, I wouldn't say aggressive, but another approach you can use is essentially, okay, we're going to fund the entity simultaneously. We're going to lock up that entity, not add any more money to it, and then everything goes pro rata. If you did add money to it, let's say there was additional need for money and there was additional capital contribution by either you or your IRA, then maybe an argument can be made that you've then triggered a prohibited transaction because there's been an investment into a disqualified entity. So that's why just close it up. Don't add any more money to it. Don't change the percentages. Profit and losses all go pro rata. Don't add any services. Don't take any money out in terms of from a salary perspective. You're pretty much okay based off the Swanson case. And that's been an approach that I've used with, my investors over the years. And it's never been, caught up in any audit. I've never had any issue with it. Just based off the parameters of Swanson is shell entity, only once it's funded, it becomes disqualified. And then just make sure you don't add any more money to it. Don't take any service compensation out, and just have everything go pro rata so that shell entity basically is disqualified at the part of funding, but it never actually triggers a further prohibited transaction rule because there's no further engagement with that entity. So it's a great question, Juan. I can do hours and hours of work on it. I'll do another blog on it. It's a really good question, but I'm happy it got put into this podcast. Third and final question is from Holly R. Holly wants to know, I'm thinking of investing in real estate in my IRA. Confused about how it would pay for a GC, a general contractor, to do the work. Would I use my IRA or do I pay for that? How exactly does the process work? So another wonderful question, Holly. Essentially, it depends on how you set up the structure, right? If you just set up a regular self-directed IRA, so you have 200 grand in your IRA, you want to buy a house for 175 grand, you open an account at IRA Financial, you wire the money to IRA Financial from your rollover IRA at Fidelity. we then send the money to the seller of the property. Title is in the name of the IRA. For example, IRA Financial Trust Company for the benefit of the Holly R IRA. And then your IRA owns it. So if you flip the property, all the gains will go back to your IRA tax rate. But let's say you got to pay the general contractor, 20 grand to do improvements. How does that work? Can you pay it? Should your IRA pay it? So remember, if your IRA owns it, the IRA's got to pay for it. You cannot pay for anything personally because that could trigger the prohibited transaction rules, just like the previous question with Juan. Anything in your IRA, you got to use your IRA money. Anything on personal, use personal money. It's like kryptonite and Superman. You don't want to mix it. Okay, so in this case, Holly, if the structure, the IRA owns the asset directly, you go to the IRA Financial, you go to our app, our website, you fill an expense report, and you say, send a check 20 grand to John Smith, or wire John Smith 20K. We'll take care of that. This way, everything comes out of your IRA, and there's no personal self-dealing or potentially prohibited transaction. But what a lot of clients do, Holly, and I'm not sure if this is something you're considering doing or have done, but something you should think about is the checkbook control LLC. So this is a perfect scenario, an example of why people like checkbook control. With the checkbook control self-directed IRA, a special purpose LLC is set up, generally set up in the state where the real estate will be located. Let's say we call the LLC ABC LLC. We'll fund the IRA the same way, right? 200 grand goes from Vanguard to IRA Financial. But instead of the IRA making the investment directly into the real estate, the IRA will invest in the LLC. So in return for the 200 grand, it will receive 100% of the LLC interest. So the IRA will own 100% of the LLC, just treated as a disregarded entity. And then the LLC will buy the real estate from the seller. So in this case, with the checkbook control LLC, Holly, title to the real estate will be in the name of the LLC, not the IRA. What does that do? Gives you more privacy, gives you limited liability protection, meaning it protects your assets outside of the LLC, which is important, especially for real estate. But more importantly, and relevant to this question, it gives you what's called checkbook control. So if you want to write a check, if you need to pay the contractor or pay taxes or buy furniture or whatever it is for the real estate asset, you can do it as the manager of the LLC. You do not need to go to IRA Financial. You can do it, and that's what checkbook control is. So it saves time, makes it more efficient, probably cheaper because you don't have to interact with us, even though we don't have transaction fees, just wire fees, all this annoying stuff. You can get things done quicker as the manager of the LLC because our operating agreement allows you to have this type of control. Again, you're not paying yourself anything. All you're doing is acting as a conduit to allow the LLC to manage and operate the real estate investment, which gives you the ability to essentially write checks or wire money. That's it. No services being performed that's not reasonable and necessary. You're not taking a salary for it or any fee. You're just basically serving as your role as manager in a very limited context, which in this context, in the case of the self-directed IRA, means affecting transactions and record keeping, hiring lawyers, accountants, whatever you need to do to keep the LLC in good standing. But what we've done here, Holly, is number one, we're giving you privacy. Title is not in the name of your IRA. It's in the name of your LLC. Hard to know who's behind it. Giving you more control. You got checkbook control or wire control. You can get your GC paid much quicker than you could through IRA Financial. Thirdly, and just as important, giving you limited liability protection. So if you have IRA money outside of that LLC environment, it's going to be protected from any asset or creditor attack. All they'd be able to attack is what's in the LLC, not what is outside it. So that is all very, very important. And when you put it all together, that's why the checkbook control structure has become really the most popular way for folks who want to buy real estate in their IRA to do so. And it's actually a really good example, good question, because this is something that people kind of don't always understand. And then they set up a self-directed IRA and are dealing with paying the LLC, or not just dealing with the day-to-day operations of the real estate investment, whether it's paying taxes or general contractor or paying for a plumber, whatever it is. It's just much easier if you could just write the check or Venmo the money from the LLC, not using personal money, Holly, using the IRA money through the LLC, giving you the ability as the manager of the LLC to pay for those expenses much quicker than you would if you have to go through a self-directed IRA custodian. So that's it, Holly. Thank you, Holly, Juan, Isaac. 3 great questions on real estate IRA. Check out next week's podcast. It's going to be version 2 or episode 2 in the real estate IRA series. there's going to be a lot more great questions on using an IRA or 401k to buy real estate. So thanks again for listening. If you're watching on YouTube, really appreciate it. You should definitely subscribe. It's a great channel. If you have questions, leave comments on Facebook, Instagram, X, LinkedIn, our amazing YouTube channel, or you can send us an email to info@IRA Financial. It's a great way to submit your question. You don't have to be a client. Again, I don't even tell people's full name or where they live. I'm just using your first name and then the first initial on your last name, total privacy, anonymity. So you can feel free to ask questions. No one's going to know who you are. You don't have to be embarrassed. The most important thing is we all get to learn from each other and become better, smarter, self-directed investors. So thanks again. Have a great day, and I'll see everyone again next week. Thanks.